So, good evening, all of you. So, in this video, I'm going to explain the FR question paper. So, conducted on the last Saturday. Okay. So, coming to the first question, answers in its a statement of financial position as at 30th June 2000 X0 and X1 thousand debentures. How much will appear in the statement of cash flows for the year ended 30th June 2000 X1 under the heading cash flows from financing activity. So coming to the cash flows from financing activity, we need to consider issue of shares or a repayment or redemption of the shares or buyback of the shares or issue of debentures or loan obtained from any dividend paid. Even interest paid is also financing activity. But in this standard, they give the option you may consider in cash flows from operating or cash flows from financing activity. So generally we consider in cash flows from operating activity. That's why we does not consider here. Okay. So here share capital increased when compared with the previous. Last year $95,000 is there. At the end, current year 1 lakh 5 means 20,000 is there. So what is that meaning? The shares may be issued at what premium? 1,000 equal to 40,000. And the 10% debentures in the last year we have 1,90,000 dollar. In the current year 1 lakh 70 means 20,000 reduced. It means what redemption. So redemption of the debentures. So 20. What is the net cash flows? Net cash flows from financing activity. So coming to the second question. An entity purchased a property for $6 million on 1st July 2000 X3. The land element of the purchase was $1 million. And out of the total property value of $6 million, $1 million portion belongs to the land and the remaining is belongs to the building. Its residual value is nil. Generally, land is not a depreciated element. So we have to calculate depreciation only on the portion of the building. On 30th June 2000 X5 means what? So here we purchased on 1st July 2000 X3 means 2000 X4 and 2000 X5. So after providing the depreciation for 2 years, the property was revalued to 7 million, of which land element was $1.24 million and the rest of the element is building. On 30th June 2000 X1, the property was sold for $6.8 million. What is the gain on disposal of the property? That would be reported in the statement of profit and loss for the year to the 30th June 2000 X7. So coming to this property cost on what 17 2000 X3. So two elements are there. One is land and building and total. So total. So for example, they purchased the property for $6 million. Out of that, land cost is $1 million, and the remaining is building cost. Then we provide the depreciation on building only because land is not a depreciated element. So $5 million by how many years are there? 50 years is the useful life. So we need to provide it for 2 years. So 5 by 50 into 2. So we need to consider point sorry point 2. Then what is the carrying amount on 30th 6 2000 x1 and here is maybe 4.8. The total is 5.8. In that case, the value of the asset is revalued on 30th 6 2000 x5. What is the revalued amount? $7 million, 1.24 and 5.76. So this is 5 what? Revaluation surplus. So what and 5.76 minus 4.8 equal to what? 0.96. So what is the total? So point equal to 1.2. 1.2. And again that asset is revalued on 30th June 2000 X7, right? So here the revaluation is given on 30th June 2000 X5. Means we need to calculate the depreciation for 2 more years. Okay. So because on 30th June 2000 X7 that property sold. So at the time of sale we need to calculate what book value. So less depreciation. So how much, what is the building cost? 5.76. Out of the 2 years already completed out of the 50 years means by 48. We need to provide it for 2 more years. So 5.76 by 48 into 2. So what is the one? 0.24. So there is no depreciation. So 0.24. Then what is the carrying amount? 60,000 x7. So 1.24. So here how much amount is the 5.52. So then 6.76 is that. Then what is the disposal value here? 6.8. So disposal, then actual carrying amount 6.76, but we sold it for 6.8. Then what? Then there is a profit. So profit on sale of property equal to 6.8 minus 6.76. That is nothing but what? $0.04 million. That equal to 40,000. So answer A. I hope you got the point. That is the second question. So the following properties owned. So of the following properties owned by the scoop should be classified as investment property. Should be classified. The first one is the property that had been leased to a tenant but which is no longer required and is now being held for sale. So that is covered under what? Non-current asset held for sale. So non-current asset held for sale. So not covered under investment property. Land purchased for its investment potential planning permission had not been obtained for building building construction of any kind. So land purchased for it, any land or building which is purchased with an intention to earn the income, that is only covered under what? Investment property. So the B is right. Okay. Then a new office building used a scoops held of office purchased specifically in order to exploit its capital gain potential. So capital gain potential. So it is covered under what? PPE, property, plant and equipment. Even appreciation of the capital is also covered under what? PPE. A stately home used for. So the answer is B. An entity had in place $1 million of 6% loan finance and $2 million of 9% loan finance. It constructed a new factory which cost $6 lakh, and this This was funded out of the existing loan finance. The factory took 8 months to complete. To the nearest thousand, what borrowing cost should be calculated? So here, generally in case of borrowing, there's two types of the borrowings are there: specific borrowing and general borrowing. So here, there is no specific borrowing. Specific borrowing is nothing but borrowing taken to finance the specific asset. But that type of wording is not there in the problem. So that's why we consider this as a general borrowing. So in case of the general borrowing, we need to calculate what weighted average cost. Weighted average cost. So, so first weighted average cost equal to what? So interest, total interest by total finance. So total interest here is nothing but 1 million into 6%, 2 million into 9%. So 1 into 6% by 1 plus 2. Okay. So 1 into 6% equal to how much amount? 0.06. So 2 into 9%. So how much amount? 0.18. 6 plus 0.06 plus 0.18 by 3. So how much? Plus 0.06 by 3 equal to 0.808 equal to what? 8% per annum. So how much amount we spent for construction of the factory? 6 lakh. So that too for 8 months. How many months it took to complete? 8 months. This 8 months is said to be about substantial period. So generally the borrowing cost is capitalized only on those assets which are covered under qualifying asset. Qualifying asset is nothing but what? The asset which took substantial period to construct or to complete. So it took 8 months. So what is the borrowing cost? So 6 lakh into 8% into 8 by 12. So 6 lakh into 8% into 8 by 12 equal to how much amount? $32,000. So the answer is 32. Okay. So this is the fourth one. Clear? Then coming to the fifth one. Tibeta acquired a new office building on 1st October 2004. Its initial carrying amount consisted of land, building structure, air conditioned system. The estimated lives of the building structure and air conditioned system are 25 years and 10 years. 25 years meant for building, 10 years meant for air conditioner AC. So when the air conditioner system is due for replacement, it is estimated that the old system will be dismantled and sold for 5 lakh. Means it is nothing but what? Scrap value. So depreciation is the time apportioned where appropriate. At what amount will the office building shown in the Tibet statement of financial position as of 31st March 2000 X5? Actually purchased on what? 1st October 2000 X4. So we need to calculate the what we need to provide the depreciation and reduce from the cost. And that too the depreciation provided for how many months? October, November, December, January, February, March. Means we need to provide it for 8 months. Okay. So which properties are there? One is a land, another one is a building, and another one is a AC. What is the cost on 1st October 2000 X4? So nothing but 2000, 10,000, 4,000. So 2000, 10,000, 4,000. Total 16,000 is there. Then coming to the depreciation. So for how many months? 8 months. Sorry. So October, November, December, January, February, March for 6 months. So in case of land, there is no depreciation. Coming to the building. So 10,000 by what is the useful life here? 25 years. Uh, So 10,000 by 25, 400 into 6 by 12. You need to provide it for 6 months. Into 6 by 12 equal to how much amount is that? 200. And so here 4,000. So he clearly stated there is a scrap value here. So 4,000 minus 500, right? Minus 500 by 10 years into 6 by 12. 4 minus 5 is 3,500 by 10. So into 6 by 12 means 2. So 175. Then carrying amount. So on 31st March 2000 XY. So land is same 2000. So 10,000 minus 200. So how much amount is that? 9,800. So 4,000 minus 175. So nothing but 3,825. Then what is the total amount if you calculate? So 11,800. So nothing but 14 plus 1, 15. 15,625. So answer is yeah. Okay. Which of the two of the following statement about IAS 20 accounting for government are true relating to what government grant? So we need these four. Two are correct. We need to specify the two. Must be deducted from carrying them. So here it stated must be. So that's why actual in case of grant received for capital asset, there are two options are there. We may deduct from the carrying amount of that asset or we may show it as a deferred income, right? So Kabati A is wrong. A government grant relating to purchase of asset should be recognized in profit and loss over the life of the asset. That is belongs to a deferred income. So B is right. And free marketing advice provided by government department is excluded from the definition of the government grant because here we consider only monetary grants. Non-monetary grants are not covered. So this is correct. Any required repayment of government grant received in earlier reporting period is treated as prior period. So nothing but what a repayment of the government grant. It is not a prior period item. It is an extraordinary item. We have to specify it separately. So the answer is B and C. Clear? So 6 B and C. Which of the following cannot be recognized as an intangible non-current asset in GH case consolidated financial statement position at 30th September 2000 X1? GHK spent $132,000 developing a new type of product in 1st June 2000 X1. Management worried that it would be too expensive to fund. The finances to complete the project came from cash injection from the benefactor received in November 2000 X1. Okay, so here the amount spent by the part. Generally, the amount of the development expenditure is capitalized only after completion of the product research. So only when the but already in case of the development expenditure, we discussed some points. What are the conditions required to be considered for considering the development expenditure as a intangible asset? And one of the point is nothing but so there is an intention to complete the project. So, but here the management worried about that it would be too expensive to fund. So the finance to complete the project. So that's why it is not treated as an intangible. GHK purchased GHK purchased a subsidiary during the year. During the fair value exercise, it was found that the subsidiary had a brand name with an estimated value of $50,000, but had not been recognized by the subsidiary as it was internally generated. As it was internally generated. So Second, BC, GHK purchased a brand name for the company. This is the purchased brand. So we have to consider it as an intangible. GHK spent $21,000 during the year on development of the new product. After management concluded it would be viable in November 2000 X0, November 20X0. The product is being launched on the market on 1st December and is expected to be profitable. Expected to be profitable means it is going to provide what? Some future benefits. So D is correct. D is treated as intangible. So answer is A. It is not treated as an intangible. So for 7A. Typical business with year ended of 30th September 2004. Demsico commenced the development stage of the new drug on 1st January 2004, 40,000 per month, and was incurred until the project was completed on 30th June 2004. So remember, so actually the development starts from 1st January 2004. So 1st January 2004. So and it start close with 30th June 30th June 2004. So each month how much amount? 4,000. So 4,000 per month. So into how many months are there? Jan, Feb, March, April, May, June. 6 months. So 24,000 is spent. When the drug went, went into immediate production, the directors become confident of the project's success on 1st March. What is that meaning? Till the 1st March, they don't have any confidence and they don't have any confidence on completion of that project. So then for the amount spent on January and February, 2 months is expensed. That is expensed. So then how much amount out of that? January and February is expensed. So 4,000 into, so 4,000, sorry, 40,000 amount. So nothing but 2 lakh 40. So 40,000 into 2, nothing but what? 8,000. Then they have bit confidence from 1st March. The drug has an estimated lifespan of the 5 years. So then the remaining portion is treated as a capitalized. Capitalized is how much? The remaining part 1,80,000. And its useful life is stated as how much? 5 years. So useful life is 5 years. So then tell me what is the question? What amount will be Dempsey's charged to profit and loss for development cost, including the amortization for the. So here this amount transferred to profit and loss. That is the first one. So here amortization amount 1,80,000 by 5. 1,80,000 by 5. So how much amount? 36,000. How much amount? 36,000. But it is for 12 months. But in this, so only 4 months are there. So 4 by 12. 4 months. So March, April, May, June. So how many months are there? So 4 months. So four months. So how much? Sorry, this amount is 1,60,000, right? 1,60,000 into 5 into. So how many months we have to consider? So we clear 1,60,000 by 5 into, so by 12 by 12. So so bad. So here the asset is recognized on what date? 30th June 2000 X4. But So we need to calculate the amortization expense for July, August, September into 3 by 12. So into 3. How much? 8,000. So this is also transferred to P&L. So total amount to transfer to P&L is 8,000 plus 8,000. 80,000 plus 8,000. 88,000. 88,000. This is the one. So answer is D. So Relay acquired a non-current asset on 1st October 2009 at a cost of $1 lakh, which had a useful life of 10 years and a nil residual value. The asset has been currently depreciated up to in the one Y1. So Y2, Y3, Y4. How many years are there? 5 years. So they provide the depreciation for 5 years. At that date, the asset was damaged and impaired. Impairment review was performed on 30th September. The fair value of the asset less cost to sell was $30,000. 30th September 2000. First, we calculate what book value. So, carrying amount on 30th September 2000 Y4. So, nothing but 1 lakh. 1 lakh. How many years? What is the useful life? 10 years. So, what is the depreciation? 1 lakh by 10. How many years we need to provide? 5 years. So, 50,000. Then, fair value less cost. Fair value less cost is provided as how much? 30,000, right? Then expected future cash flows for 8,500 per annum for the next 5 years. So means that is a future cash flow. We need to calculate what present value of that future cash flow to know the value in use of that asset. The current cost of the capital is 10%, a 5 years maturity, annuity of $1 per annum at 10% would be presented value of 3.7. And that means 8,500 into 3.7, and then we get what? Value in use. So 8,500 into 3.79. So 32,215. Then what is the recoverable amount? Recoverable amount is nothing but higher of value in use and so fair value less cost, nothing but NRV. This is what NRV. So 30 or 32,215. 32,215 is the recoverable amount. So here is nothing but this amount is more than, sorry, this amount is less than carrying amount, right? So there is a chance of what? Impairment. So then here we need to calculate what? How much impairment loss charged. So impairment. So what is the impairment loss? Carrying amount minus recoverable amount. So 50,000 minus 32,215 equal to how much amount? So minus 50,000. So 17,785. 17,785. So that is the answer for ninth one. Clear? Next. The International Accounting Standard Board's conceptual frameworking for financial reporting identifies the qualitative characteristics of the financial statement. So which two of the following characteristics are not fundamental qualitative characteristics according to IASB? Generally, coming to qualitative characteristics, two are there. So, so fundamental qualitative characteristics are there and extended qualitative characteristics or additional qualitative characteristics are provided. Fundamental qualitative characteristics are two, nothing but relevance and faithful representation. And the remaining B and D, nothing but reliability and comparability are not covered here, are not covered in the fundamental qualitative characteristics. So answer is B and D. So Mario has incurred the following cost in relation to the unit of inventory. The raw material cost 1.5, import duty, direct labor, subcontractor labor cost, recoverable sales tax, storage cost, production overhead. There was a problem with first batch of items produced. So abnormal wastage cost 0.10. So per unit have also been incurred by. So Mario, at what cost should Mario value the inventory in its financial statement? So first, which items are included? Raw material cost is included, import duty is included, direct labor is included, subcontractor labor is included. Then recoverable sales tax is not included. So recoverable sales tax, because that amount is recoverable, we have to show it as a asset, not a cost. So recoverable sales tax is not included. Then storage cost is specifically excluded. Clear? Already we discussed storage cost and abnormal cost. So abnormal wastage, those are not, and administration overhead, selling and distribution, those are excluded. Production overhead is included. So there 10. So 0.10. Then what is the answer? So 1.5 plus zero point 0.4 plus point. So coming to 11th one. 1.5 plus zero point 0.4 plus zero point 0.5 plus zero point 0.8. So recoverable sales tax and storage cost are not included, but production overhead is included. Production overhead. So how much amount? 1.5 plus zero point 0.4 plus zero point 0.5 plus zero point 0.8 plus 0.25. So how much amount? 3.45. So abnormal wastage is provided. That abnormal wastage is not considered. So the answer is 3.45. Okay. So 3.45, nothing but B. Okay. Then on 30th September 2004, Razor closing inventory was counted and valued at its cost of $1 million. This included some items of inventory which had cost 2,10,000 and had been damaged in the flood on 15 September 2004. These are not expected to achieve their normal selling price, which is calculated to achieve the gross profit margin of 30%. The sale of these goods will be handled by agent who sell them at 80% of the normal selling price charges, so as or a commission of 25%. So here the total cost is $1 million. That is nothing but what? 10 lakh. Here normal stock is there and some of them damaged. So damaged. So general normal stock is valued at cost. So damaged part is provided at 2 lakh 10,000. So damaged cost is provided at 2 lakh 10,000. This is the cost. Then what is the selling price? Because we need to calculate what is the cost or NR. We need to reduce that amount to NRV. Because in case of damage, the 100% is not recovered, right? So these 2 lakh 10,000 expected to generate the gross profit of 30%. Then 2 lakh 10,000 by zero point 0.7 equal to 3 lakh. Then this is the cost. Then we need to calculate what NRV. NRV is equal to what is the estimated selling price. So 3 lakh into 80%. Clearly stated. So 2 lakh 40,000 minus cost. So cost is how much is stated? 25%. So 2 lakh 40,000. Generally on sales we provide the cost. So 2 lakh 40,000 into 0.25, 25%. How much amount? 60,000. thousand is there. So NRV is 1,80,000. So here, what is the cost? 2,10,000. What is the NRV? 1,80,000. So then cost or NRV at 1,80,000. Out of the two, 10 lakh, 2,10,000 is there. Then what is the remaining part? So 10 lakh minus 2 lakh, 10, nothing but 7,90,000 is there. Then what is the value to be shown? 7,90,000 plus, right? 7 lakh 90,000 plus 1 lakh 80,000, that is equal to 9 lakh 70,000. 9 lakh 70,000. That is the actual amount to be shown in the closing stock. Clear? Then, so at 1st October 2004, BK had accrued interest payable of $12,000. During the year ended 30th September 2005, BK charged a finance cost of 41,000 to its statement of profit and loss, including unwinding a discount relating to the provision stated at its present value of $1,50,000 at 1st October 2004. Okay. The closing balance of the accrued interest payable account at 30th September 2005 was 15,000. BK has a discount rate of 6%. So, in that case, so how much interest paid should be shown in statement of cash flow? We need to calculate 13. So for that purpose, better to open what accrued interest account. So accrued interest, what is the opening balance? So by balance brought forward, how much amount is that? 12,000. Then current year charge is 41. So by statement of profit and loss, 41,000. What is the discount rate is 6%, right? The discount rate is what? 6%. So 1,50,000. If you then they will provide the discount. So to discount or reduction in the value. So 1,50,000 into 6%. How much? 9,000. Then what is the closing balance? So two balance carry forward is 15,000. Then the remaining amount is nothing but what? To bank. So 53 minus 24. 53 minus 24. How much amount is there? 29,000. That is the amount to show. 29,000 is the correct. So which item would be not be shown in statement of cash flow using the indirect method? Generally, in case of indirect method, what we do? So we start with profit before tax, add non-cash expenditure and non-operating expenses, and less non-cash incomes and non-operating incomes, if any. Then we reduce what? Changes in working capital. Then we reduce tax and interest paid. Then we get what? Net cash flows from operating activity. If any extraordinary items are there, those are considered. So here, so cash paid to the purchasing machinery, this is shown in uh, investing activity. Cash paid to the shareholder as a dividend, this is financing activity. Cash paid to redeem, but cash paid to employee, actually this is an operating activity, but consider in case of direct method. But here he is asking us indirect method. So answer is here. Not shown in cash flow statement is here. Okay. So IAS 7 statement of cash flow sets out the main headings to be used in statement of cash flow. Which two of the items given would be included under the heading cash flows from operating activities? Which of two of the items below would be included? Considered. Tax paid is considered. So we have to reduce the tax. Purchase of investment is investing, not forming part of operating. So loss on disposal of machinery is considered. Add back to the profit before tax. In case of what? Indirect method. So purchase of equipment, investing. So which are considered here? A and C. So majority of the student asking this question. So very so important, and we can expect a minimum one question. So in descriptor. So coming to the single entity means individual entities financial statement. So most of walk in footsteps of the top tutor. So sorry. The following trial balance extract that it's not a complete trial balance relating to the most as at 30th June 2005. Revenue, cost of sales, R&D, distribution cost, administration expenses, loan note interest and dividend paid, interest investment income, equity shares $1 each. So corresponding notes are provided. So 5% loan note retained earnings as at 1st July 2006 for revaluation surplus. Opening is given. Other components of equity, maybe it is a security premium. Other components of equity is nothing but security premium because already equity share capital was provided. Property at valuation. So 1st July and plant and equipment and accumulated depreciation plant and equipment. Monster commenced a research and development project on 1st January 2005. It spends 1 million per month. 1 million per month on research until 31st March 2005, at which date the project passed into development stage. So means so January, February, March. Till this, so it is covered under research, should be expensed. From this date, it spent 1.6 million per month until the year end, 30th June 2005, at which date development was completed. However, it was not, not until 1st May 2005 that directors of Monster were confident that the new product would be commercially success. So they don't have any trust on that development phase. So they got the confidence from 1st May. So we have to capitalize from the 1st May onwards. Whatever the amount spent before 1st May will be expensed and is transferred to profit and loss statement. Expense at research and development cost should be charged to cost of sales. So coming to the six. So we have research and development. He clearly stated John, Feb, March, completely covered under research. And so April, May, June, covered under what? Development phase. So out of that, he don't have confidence till 30th April. He got the confidence from 1st May. So this is how much amount expensed for 1 month. Nothing but April. Then capitalized is how much? So May and June is capitalized. Then what is the research phase? On research, they spend 1 million per month. How many? 3 months. 3 into 1 equal to $3 million. And for development phase for 1st March, 1st April, 1.6. So 1.6 million. How much amount capitalized 2 into 1.6 equal to $3.2 million. So how much amount expensed? So transferred to. So దేని ట్రాన్స్ఫర్ చేయమన్నాడమ్మా కాస్ట్ ఆఫ్ సేల్స్ ఈక్వల్ టు 3 plus 1.6 equal to $4.6 million. And this amount we are going to capitalize. We have to show in profit and loss statement. Clear? This is the first one. I hope you understand the first point. Coming to the non-current asset, Mostyn's property is carried at fair value, which it which at the 30th June 2005 was $29 million. So remember, in case of revaluation, in case of revaluation, first you need to calculate what is the carrying amount on 30th June. So the property details are provided here. Property at valuation on 1st July 2004, 28,500. But valuation done on 30th June 2005. First we need to provide what? Depreciation. The remaining life of the property at the beginning of the year was 15 years. Monston does not make an annual transfer to the retained earnings in respect of revaluation surplus. So ignoring deferred tax on revaluation, plant and equipment is depreciated at 15% per annum using the reducing balance method. No depreciation has yet been charged on any non-current asset for the year ended 30th June 2005. All depreciation is charged to cost of sale. Again, depreciation is also transferred toward cost of sale. In case if the depreciation is a transfer, then automatically impairment loss is also transferred toward cost of the sale. Then first calculate what depreciation. This is the other topic is that here what revaluation. So on property, what is the property cost? 28,500. So the remaining life is 15 years. Clearly stated, the remaining life is 15 years. So 28,500 by 15. How much amount? 1900. So another one is so plant and equipment. Plant and equipment cost is 27,100. But here we have to follow reducing balance method at 15%. In case of reducing balance method, we calculate the depreciation or return on value. What is the return on value? Costless provision for depreciation. That is nothing but 27,100 minus 9,100 into 15%. Right? So 27,100 minus 9,100 into 15%. How much? 2,700. What is the total amount of depreciation here? 4,600. So here we have to calculate 28,500. Sorry, 28,500 minus 1,900 equal to 26,600. So next 27,100 minus 2,700 equal to 24,400. These are the carrying amount. This is what the part of the depreciation, and remember this is also transferred to what? Cost of sales. Cost of sales. And another point mentioned in this point, in another situation specified in this point, revaluation. So revaluation happened on 30th June 2000 expired. What is the property cost? 29. Then what is the, sorry, revalued amount of property? So plant and machinery is not revalued, right? How much amount? 29 million. So we need to convert, right? So these are mentioned in thousands. Okay. So how much amount? 29,000 minus, so 29,000. Then what is the revaluation surplus? So 29,000 minus 26,600. What is the revaluation surplus? How much amount is there? Minus 26,600 equal to 2,400. 2,400. That is what revaluation surplus. And that is transferred to what other comprehensive income in profit and loss statement. And coming to the financial position, we show it in retained earnings. We have to show it in retained earnings. Clear? That is the point. Working note 2. Then coming to the third one. So working note 3. So relating to what loan notes. 5% loan note was issued on 1st July 2004 at its nominal value of $20 million, incurring the direct issue cost of 5 lakh. So, which have been charged to administration expenses. Actually, this $5 lakh charged to administration expenses. Charged to what? Administration expenses. Clear? So, remember that point. The loan note will be redeemed after 3 years at a premium which gives the loan note an effective finance cost of 8% per annum. Annual interest paid on 30th June 2000 X5. Here we need to prepare these statements on 30th June 2000 X5. So interest on loan notes. Actual what is the total interest? $20 million minus 5 lakh. So how much? $19.5 million. So actually this is the net amount of loan into. Okay. So that is what net amount. So that net amount into what is the rate of interest. So rate of interest provided as we need to consider what effective rate of interest. What is effective rate of interest? 8% per annum. So 19.5 into 8%. Then we need to convert into thousand, right? So 1,560 million dollars in thousands. $1,560, and that amount is reduced from respected administrative expenses. So what is the administrative expenses we have? 6,800. Then further term we have the note. So 6,800 minus 500. So means direct issue cost will be reduced from the proceeds. So 500 is reduced. Then administrative cost we have to show 6,800 minus 500, 6,300. Then provision for tax for the year ended 30th June 2000 X for $1.5 billion. 1.2 is required together with increase in deferred tax provision to be charged. Profit and loss. So we have to consider $1.2 million of income tax and deferred tax of 8 lakh dollar. So nothing but 1200 plus 800, 2000. 1200 plus 800. How much amount? 2000. Monster paid a dividend of 20 cents per share on 30th March 2000 Expo, which was followed the day after by issue of 10 million equity shares at their full market value. Actually, what is the issue of the shares? Equity shares we have 30,000, but actually what is the opening? $10 million, 10 million equity shares are issued after payment of the dividend. So we need to calculate the dividend on 20,000 dollars, 20,000 dollars of equity shares. Prepare statement of profit and loss and analysis in equity and cash flow statement. So we need to calculate, prepare what? The first one is statement of profit and loss for the year end. 1 minute, Amma. So we have to prepare what statement of profit and loss. So then first we consider what revenue. So we consider in thousands. What is the revenue provided? 1,13,500. Then coming to what is the cost of sales we have? 88,500. Then so which elements are included? Remember R&D expense amount is included and depreciation. Okay. So R&D amount is $4.6 million, right? Depreciation is total 4,600. So $4.6 million means 4,600,000, right? So 4,600 plus 4,600, 88,500 plus 4,600 plus 4,600 equal to 97,700. This is nothing but what gross profit minus 15,800. Then we add what other income. So in this problem, is there any other income? Verify. Invest. So 16,100. So then we go for, so distribution cost is there. How much amount? So 2,800. Administrative expenses. R&D is not considered because that was considered in cost of sales. So administrative expenses. What is that? Out of that 5 lakh here, 5 lakh loan notes relating to the loan notes, nothing but if you convert 500. So 6,300 is that. Less next, and one next element is loan notes related, nothing but finance cost. Dividend paid is not considered. Dividend paid is considered in uh, after P&L, net not considered in net profit because that is an appropriation. Finance cost is already calculated as how much amount 1560. So that is nothing but working note 3. So better to give the references. Okay. Next, interest income is considered. Equity share capital, statement of changes in equity, loan notes. So cash flow statement, retained earnings. So statement of changes in equity, other component statement, revaluation related, depreciation. Depreciation already considered in cost of sales. Then, then that is what profit before tax. How much amount is there? 16,100 minus 2,800 minus 6,300 minus 1560 equal to 5,440 plus tax. So here two taxes are there, income tax and deferred tax, right? So income tax is $1.2 million, nothing but 1,200 in thousands plus 800, nothing but 2,000. So this is profit after tax which is transferred to retained earnings sum. So 3,440. 3,440. Add other comprehensive income because we have to consider here we have the revaluation surplus if you remember. Comprehensive income. So revaluation, so that is nothing but revaluation surplus. So we have what, 2400. So total comprehensive income. So total comprehensive income, how much amount is the 5840. This is statement of profit and loss. Then second one, we need to prepare statement of changes in equity. So statement of changes in equity for the period ended. So what are the particulars? Share capital, security premium, retained earnings, revaluation surplus, total. Okay, so this is the total. So then opening balance. So opening balance we have, so equity share capital 30,000, but in the working note he clearly stated $1 million equity share. So $10 million equity shares are issued after payment of dividend. Means the $10 million is the additional issued during the year. So then what is the opening balance? 20,000. Okay, so all are mentioned in thousands. Then, so what is the security premium is nothing but other component of equity. So other component of equity is a provided. So what is the other component of equity? 9,300. But here, so so in the last one, he mentioned Moston paid a dividend of 20 cents per share on 30th March, which was followed at the full market value of 1.7. Nothing. So then, how much amount is there? Around 17,000. 17,000. Out of the 10,000 is the share, means the share capital, nominal value. The remaining 7,000 is nothing but what, security premium. So out of the total 9,300, 7,000 security premium is relating to the current year. Then the remaining 2,300 is opening. And the retain, because here the date is not mentioned for equity shares and other components, but remaining others the date is mentioned. Retained earnings clearly stated what is the opening balance, 6,200. Revaluation surplus, what is the opening balance, 3,000. Because neither is no other element. So what is the element, 20,000. So plus 6,200 plus 3,000, 31,500 less. So addition sum, nothing but issue of shares. He clearly stated $10 million, nothing but 10,000, 7,000, because those are purchased at fair value, 17 lakh, nothing but 7,000 is security premium. So total 17,000. Next, revaluation surplus. During the year, how much amount is created? 2,400 plus retained earnings. What is the retained earnings? We transfer only profit after tax. Nothing but 3,400 less. We need to pay what? Dividend. So dividend is how much? Only we consider one opening balance. So 20,000 into 0.2. Then closing balance. So how much? 13,000, 9,300 100, 7,000. So, okay, then, sorry, 6,200 plus 3,400 minus 4,000, 5,600 and 5,400. So 5,600, 564, then total 50,340. Then this is what the statement of changes in equity. Then others, prepare the extract from the statement of cash flow for the year ended. So coming to the cash flows. So in case of investment, there is no asset purchased during the year, but one element is capitalized, nothing but development cost previously. So development cost, how much? 3,200. And no asset purchased, no asset sold during the year. So no asset purchased and no asset sold. Nothing but 1.6 into 50, if you remember. So how much amount is there? 3,200 net. Next, cash flows from financing activities. So here issue of shares are there. So how much? 10,000 plus 7,000. So $1.7 million, right? 1,700, 17,000. And the another one is dividend paid. What is the dividend paid? So 20,000 into zero point 0.2 is nothing but what? 4,000. And loan notes are there. And how much loan notes are issued during the year? So nothing was stated. Issued on 1st July 2000 X4. Issued on 1st July 2000 X4. $20 million incurring direct issue cost of 5 lakh. Then issue of loan notes. So $20 million is nothing but 20,000. Then cost of the issue incurred 5 lakh, nothing but 500. So 19,500. This is the investing activity. Okay. So verify is any income. Sorry, investment income we missed. So in case of investing, investment income is added because that is also inflow. So 300. So these are the cash flows relating to investing activity and financing activity. Clear? This is the problem. I hope you guys understood. So if you have any doubt even after seeing this video, then please free to call me anytime or else just WhatsApp me. I will clear your doubt or you may ask in the tomorrow's class. Okay. So thank you, Amma. Take care of. Good night.